Visa and Mastercard are under fire as Congress demands they roll back planned fee increases. I'm your host, Steven Van Metre, and thanks for joining me today. With inflation continuing to be a political issue, Congress has weighed in and has asked Visa and Mastercard to cut back those fee increases. And we're going to continue our chat about how high producer prices aren't as good for the economy as everybody thinks. Let's pick this story up where we head over to the Wall Street Journal, who headlines that Visa MasterCard fees to hurt consumers. Senator Dick Durbin says lawmakers are urging companies to call off plans for raising credit card fees on merchants. The two big payment networks are planning this month to raise the fees that many large merchants pay when they accept customers' credit cards, the Wall Street Journal previously reported, and we covered. In a letter sent to the networks Friday, lawmakers said the fee increases would ultimately trickle down to shoppers who are already struggling with runaway inflation. And they've got that right, because inflation is off the charts, the highest level we've seen since the 1980s, running at 8.6% year over year and going vertical, and have many believe that this thing's going to double digits and soon. And all this adds to the story of this inflation problem. And it's a very human story, right? We want something we can't get. We need inflation because the debt-based system needs inflation. We can't get it, can't hit the Fed targets, and then we get it. And all of a sudden, we don't want that at all. And everybody from the top down is starting to scream. Let's continue to see where the story goes, because higher costs are the last thing American families deserve right now, wrote Mr. Durbin, an Illinois Democrat. The letter, which was reviewed by the Journal, was also signed by Republican Senator Roger Marshall of Kansas, Democratic Republican Peter Welch of Vermont, and Republican Representative Beth Van Duyne of Texas. And yes, again, this is a political issue. As people face re-election at the midterms, you can better believe that consumers will be voting with their wallet, and high inflation is a sign to send people out the door. And that's why you're going to see continued coverage from Congress saying, cut these fees, get inflation down. They're desperate. And the fees the lawmakers reference aren't paid directly by consumers. So really, it doesn't matter, right, if consumers aren't paying it, but they are, as you know. Instead, clothing stores, restaurants, and other merchants pay so-called interchange fees whenever a customer pays by card. Visa and Mastercard set these fees, which are pocketed by card issuers. Merchants can pass them along to customers in the form of higher prices. And you better believe that they're going to do that. Right now, the margin for many small businesses isn't there to cover this extra cost, so you can bet it's going to be passed on to consumers, and that's what Congress is worried about, is that prices are going even higher at a time when consumers can't afford them. Electronic payments play a critical role every day and have proven even more valuable since the start of the pandemic, according to MasterCard, and that's why we're seeing merchants encouraging their customers to use electronic forms of payments due to the significant value they receive in return, a safe, convenient experience, and a guaranteed payment. Now that baffles me about the guaranteed payment, because anybody who's charged something back or contested a charge with a merchant, and if you're on the other end as the merchant, particularly a small business, you know what happens. The credit card company generally sides with the consumer and pulls that money back. So how this is a safe, guaranteed form of payment, say compared to cash, well, you've got me on that one. But hey, when you're a behemoth the size of Visa and MasterCard, you can throw your weight around for sure. Because many of the fee increases expected this month were already delayed during the past 2 years because of the pandemic. And you can see that Visa and MasterCard's credit card interchange fees by consumers hit a whopping $55.39 billion in 2021, and you can better believe that number is going up when these fees go through. Their planned fee charge changes will include both increases and decreases. According to MasterCard, they're lowering their costs for all merchants with transactions below $5. Visa said it will lower fees for some small business. The April adjustments will lower interchange fees for most small businesses. This letter is evidence that the big box retailers don't like that. Well, and absolutely they don't. But if you are, of course, a small business, you need all the reprieve you can get, because those big businesses are tough to compete with and dollars are getting scarce. So any help is better than none. Of course, anything that leads to higher prices, people are going to complain. Mr. Durbin is a longtime critic of the two networks, He is a namesake of the Durbin Amendment, a part of the 2010 Dodd-Frank Act that capped the interchange fees that merchants pay to large banks when customers shop with debit cards. Visa and Mastercard handled about 85% of all debit card spending last year that occurred on cards issued in the U.S. Visa and Mastercard's credit cards made up about 72% of spending on U.S. issued credit cards. So when Visa and Mastercard talk, well, people listen because they've got a lot of weight, and it takes perhaps an act of Congress, literally, to keep these fees from going through. So it'd be interesting to see if Congress actually pushes forward and starts to do something if Visa and MasterCard decide not to back down. But we already know that high prices will lead to a recession. Of course, it's not just the coming midterms that's the issue. It's the coming recession that's going to be a problem. But that's not something that should be a problem for your portfolio. I'll put a link up to Portfolio Shield here in the corner of the description below. Be sure to check it out when you have some time. Now let's continue on with our producer price story, because many of you have really found some value in how high producer prices don't lead to inflation. And let's revisit our story of the two taco carts. And we've got a taco cart in a high cost zone where taxes are high, wages are high, regulations are high. And if you produce tacos in that zone, your costs are going up and they're high. But 3 blocks away is where your taco truck is at, and it's excluded from all of those laws and regulations and rules, and your cost to manufacture tacos is far less than it is or in that high cost zone. But when you look over, the people that live in the high cost zone are eagerly standing in line and buying tacos despite prices going up rapidly. So what do? You hire some people and say, I want you to take these manufactured tacos that I've completely made, and I want you to transport them 3 blocks over and sell them. And now you've got an idea of just how global trade works, with the U.S. being the high cost zone, if foreign producers being the low cost zone. All they have to do is ship their goods over to the other 3 blocks away in this example and sell them. So when we talk about high producer prices and they lead to a lot of imports, that's valid. But it also leads to a lot of layoffs. And let me show you how that works. And here we can see the 4-week moving average of initial claims against the producer price index on a year-over-year rate of change. And so when producer prices rise rapidly, here you see in red, what happens? Initial claims start to go up. Producer prices rise, claims go up. Producer prices go up and they hang out there, and finally claims go higher. Here you see producer prices leading claims higher, producer prices again leading claims higher. And this time it didn't happen here around 2018, but let's go to the next slide where we have to adjust the left scale to a log scale because, well, due to the pandemic, things get off the chart. And here you see producer prices way off the chart compared to unemployment claims. And so what actually happens here is these low-cost producers actually eat into the profits in the high cost zone because they can export into that zone. Now, what's helping the U.S. right now is the pandemic, in a sense that all the slowdown in shipping and all transportation networks is actually allowing U.S. producers to take advantage of these high production costs and pass it on to consumers. But as the pandemic fades and more goods flow into the United States, well, you can only imagine that foreign producers are dying to get their goods here because they can make big fat profits off U.S. consumers due to the high production costs. And ultimately, what happens now is you'll see these low-priced foreign goods, or tacos in our example, will eat into the profits of the U.S. producers, who will ultimately see their business go down. And then what will they have to do? Well, they ultimately lay off, and it sends the economy into recession, leads to, of course, lower consumer prices and lower interest rates because there just isn't enough money in the system to keep that high production cost running, particularly when in a global economy where the dollar is a reserve currency, when prices in the U.S. go up really high. Well, that's just an open door for foreign producers to come in, steal market share, and drive prices back down. So now you know when you see all this talk about high producer prices leading to inflation, it doesn't lead to that at all. It leads to deflation, leads to unemployment, and it's generally a bad thing for the U.S. economy. And with that, I'm Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.